Okay, hello everyone. Welcome back. This is Professor Lei. So in this video, we will continue to talk about capacity management. All right, and more specifically, we will talk about two main different quantitative methods that we can frequently use within the procedure of capacity management. All right. So the first type of the problem basically is to determine the capacity requirements, okay, during the no matter the manufacturing or service process. Okay, here I would like to use the example for one to help illustrate how we basically use some related concept, all right, or related methods, quantitative methods, in order to determine the capacity requirement. All right, so let's first look at the simple context. All right. Suppose that actually this steelwork company are producing two flavors of salad dressing. All right. One is called Paul's and another one is called Newman's. All right. So suppose that no matter Paul's or Newman's, all right, each is available in bottles and or single service bags. Okay, two different type of format, either bottles or single service serving bags. All right, and the question basically is asking what would be the equipment or labor, okay, that is required for the next 5 years if we want to basically fit for the market demand, okay, of the two different flavors in two different, um, kind of setting ways. All right. Now, in order to actually answer this question, we have to have some specific facts about the market demand. All right. So suppose right now we already use very sophisticated, very clear forecasting way to predict the sales of two different type of salads. All right, in the next 5 years. All right. So in this table, you can see that basically we show each salad in different, either in bottle or in plastic bags. Okay, the corresponding prediction. Okay, the corresponding prediction of the next 5 years are all showing within this table. All right. So give you a quick example. Let's say for this number, all right, it means that okay, for Paul's favor, the favor called Paul's, okay, we would predict that the sales in bottle would be 150. Okay. So for another example, let's say for this number, it means that okay, for the flavor called Newman's, okay, the selling amount of the in plastic bags, okay, um, is predicted at 400 bags basically. All right, 400 bags. So here we basically use the forecasting technique to give this specific information, okay, in order to do the capacity management procedure. All right. So we know that okay, let's suppose that actually the forecasting procedure itself is accurate. All right. But even if the forecasting procedure itself is accurate, it doesn't mean that okay you can fit well for the market demand, right? You have to have enough capacity ability, all right, capacity management ability in order to fit the market demand. All right. So our question basically would become okay. Suppose this forecast, all right, is accurate, all right, based on the capacity level that currently our firm is having, then can we successfully fit for the market demand of those two different addressing sellers and for each type of the format, okay, uh, no matter in bottles or in plastic bags. Okay, that's what we are trying to do in this example. Okay, so so here these two sentences are exactly telling us, all right, what kind of equipment and also the labors that we currently having, that can help us to produce, no matter Paul's or Newman's in bottle or in plastic bags. Okay, you can see that first of all, the company has three machines. Okay, this three machine can be used, each of them can be used to package 150,000 bottles. Okay, basically we can view it as a bottle machine, right? So for the bottle machine, we have three, and each of them can package 150,000 each year. Okay, each year. and each machine basically has 2 operators. So this fact basically tells you a basic fact that about the bottle machine capacity level that currently our firm is having. All right. Basically, we have 3 machines for bottle. Basically, 3 machines to produce bottle, and each machine can package 150,000 bottles. And for each machine, we have 2 skilled operators that can monitor the whole procedure. That's it. All right. This is the thing that this is basically the equipment and also the labor situation that currently we have in order to produce the bottles. Okay, the bottles. Now, meanwhile, we also have 5 other machines. All right. And what about this 5 other machines? For this 5 other machine, each can package 250,000 plastic bags. Okay, the plastic bags. So basically, it means that we have 5 plastic bag machines. And each of them can package 250,000. The amount is like that each year. All right, each year. And differently, for this plastic bag machine, each machine basically has 3 operators. Okay, so this is the basic fact about the plastic bag machine. All right, we have 5 plastic bag machine. Each can package 250,000 plastic bag, and for each machine right now we have 3 skilled operators in order to monitor the whole procedure correctly. All right, so these are basically the employees and also the equipments that we have in order to produce no matter which flavor or different type of the format. All right, but currently just looking at this 2 sentences about the facts about the capacity level that our firm is having, we're not quite sure whether basically our capacity level can fit for the whole market demand of from the customer or from the market. All right, so we have to do some calculation. All right, so how to basically measure whether our capacity level can already fit for the market demand from the customer? We have to use basically a concept, all right, called utilization. Okay, so you guys already learned about the utilization, or we more specifically we call it capacity utilization in the first video. If you are still a little bit confused about capacity utilization, okay, go back to the first video of this chapter. All right, I have detailed explanation about the capacity utilization. All right, we have to make sure that our capacity level right now is already good enough to to fit for the market demand. That's why basically we need to do some calculation. All right, and see whether basically our capacity level right now is already above the market demand realization. Okay, that's the thing that we want to make sure. All right, so let's do some simple transformation and calculation here. All right, so first of all, we know this fact that this is basically the market demand, right? The market demand prediction. All right, the market demand prediction. And before the market demand is realized, we already do some forecast, right? So we know that for these 2 different flavors, right? In bottle, we need all this amount for different years, all right? And for plastic bags, we need this amount for these are all different amounts for different years, all right? And similarly for Newman flavor in bottle, we probably need this different amount for each year, and for plastic bags, we need all this different amount for each year, all right? So we know that actually we have some bottle machine and also have some plastic bag machine, all right? So first of all, by just looking at this prediction, okay, how many bottles we need to produce in year 1, or in year 2, or in year 3, or in year 4, or in year 5, okay? Similarly, I may ask a question as a firm. I may ask a question, okay? How many plastic bags we need, okay, in total in year 1, in year 2, in year 3, in year 4, and in year 5, okay? So here we know that actually no matter it's a Pulse flavor or Newman flavor, okay, each flavor basically there's some of them actually are selling in bottles, right? So basically here in year 1 we know that we predict that basically for Pulse flavor we may need 60 bottles, all right? But on the other hand, we also know that for Newman flavor, we probably need 75 bottles. Okay, so I may ask you the first question. Then what is the total bottle that we need in year one? How to do this? How to calculate this? Very simple, right? We just use the 60 to plus 75, which is 135, right? So basically, it tells you no matter, okay, this bottle you use for Paul or use for Newman, okay, in total we need to produce 60 plus 60 plus 75, which is 135 bottles. That's it. That is basically the amount of bottle that we need. All right. And similarly in year one, how many plastic bags that we need to produce in order to contain no matter Paul's flavor or Newman's flavor? Very simple. Just use 100 plus 200, right? Which is 300. Okay. So in total, in year one, it tells you basically the bottle amount that we need to produce is 135, which is 60 plus 75. All right. The total plastic bag that we need to produce basically is 300, which is 100 plus 200. That's it. All right. So you can do the same calculation for the following years from year 2 until year 5, right? Suppose in year 4, how many bottles we need in total in order to fit no matter Paul's flavor or Newman flavor? Okay, in total we need 297. That's correct. All right, and then in year 4, how many plastic bags in total we need? We need to use 400 plus 650. That's it, which is 1050. That's it. All right, very simple. So by just doing this simple addition, and then you can see we can kind of transform or translate this information into some specific information that we can use in order to calculate basically whether our capacity level right now is already good enough or not. All right. So here you see basically in this table, after we do some simple calculation, we already know that for bottle, starting from year 1 to year 5, we need this specific mass. We need to produce this specific mass. All right. That's basically the task that we need to meet in order to fit for the market demand, right? And similarly for the plastic bags, these are the mass that we need to produce in order to fit for the market demand. Okay, so this is quite simple. All right. Now, first of all, let me ask you another question. All right. Suppose since we already know this fact about the capacity for producing bottles, right? We know that this company has 3 machines and each can package 150,000 bottles. Okay, 150,000 bottles. So let me ask you this question. So in total, all right, how many bottles at most that we can produce in 1 year? Okay, how many bottles in total that at most we can produce for one specific year? How many? Since you have 3 machines, right? Every machine can package how many? 150,000 bottles. It means that for all the 3 machines, these are the 3 machines that you have. All right, you don't have 2 machines. You don't have 4 machines. You are exactly having 3 machines in your factory, right? So for these 3 machines, all right, every machine, the ability of package level is basically 150,000 bottles. That's why in total, if I ask you basically at most how many bottles you can produce within each specific year for these all 3 machines, the answer would be simply 3 times 150,000, which is 450,000. Okay, which is 450,000. That's why here, okay, you see the capacity level. Okay, the total capacity level basically is 450,000. Okay, 450,000. Okay, basically the numbers shown here in this table, you see these are all in thousands. That's why this is 135, 300. But basically the real number is 135,000, and this is 300,000. All right, so don't be confused about this. So basically the capacity shown here is 450,000. All right. So the second question, operators. Okay, very simple. Since we know that for each machine right now, or more specifically for each bottle machine, right now we have 2 operators. Okay, then in total, how many operators we have, or how many laborers that can monitor the bottle production? Okay, how many operators we have? Very simple. You have 3 machines. Each machine has 2 operators. Then how many operators in total we have that can help us, produce machine, can help us monitor the whole procedure? 3 times 2, which is exactly 6. That's why the operator show here is 6. Okay, the operators are 6. This is specifically saying that the operators number, okay, the total number of the operators that can help us produce bottle, the bottle material, okay, the bottle material. All right. So these are the capacity and operators. All right. Now let's look at year 1. Okay. So actually starting from year 1, year 2, year 3, year 4, year 5. All right. Let's look at separately. Look at them separately. All right. So now if we are in year 1, okay, think about this. What are the total bottle, okay, that's the market needs? Okay, what is the total bottle that we need to produce in order to fit for the market demand? What is that value, or what is that amount? Think about this. All right, it should be 135, right? Or more accurately, it should be 135,000, right? 135,000, since this is in thousand. All right. So basically, this value tells you how many bottles we need to produce in order to fit for the market demand, right? That's true. Okay. Then I also tell you what is the maximum amount of the bottle that we can produce. So which is basically corresponding to the capacity level of the bottle production, right? What is the capacity level? As I said, this would be 450,000, right? 450,000. So basically, we already know that the amount that we need to produce in order to fit for the market demand is 135,000. The amount that at most we can produce, okay, which is the capacity level that we have, basically is 450,000. All right. So if I want to calculate the capacity utilization, okay, I already talked about this concept in the first video. If you want to calculate, quantitatively measure the capacity utilization, very simple. Use how many amounts that we need to produce in order to fit for the market demand, divided by the how many amounts at most we can produce in this year. All right. So we use what here. You see, if we are in thousand, then basically you just show the 135 over 450. All right. Then simply you can get 0.3. What this 0.3 means? Think about this. What this 0.3 means that basically you only use 30% of your capacity level, right? Because at most you can produce 450,000, right? But you only actually produce 135. Okay? So for example, let me change a little bit. All right? Now suppose if this bottle, okay, the bottle amount that we need to produce in order to fit for the market demand is not 135, okay? It's about 200,000, let's say. All right? 200,000. Can you fit for that market demand? Yes, you can, all right? Okay, now, if we increase to 400,000, to 400,000, all right? So let's say the market demand for bottle is 400,000. Can you fit for that market demand? Yes, you still can, right? Because your capacity level is 450,000, right? And since 450,000 is greater than 400,000, you still can do that, right? But let's say if the market demand of the bottle for this specific year is 500,000, okay, it's 500,000, then can you fit for all of the market demand of the bottles? No, you cannot, because at most you can produce is 450,000. Okay, even if you need 500,000 bottles, you cannot do that because you only have 3 machines. Each machine can only produce 150,000 each year. That's why this is basically the selling, okay, the selling amount that you can produce. Okay, so make that clear. All right, try to understand what is exactly the meaning of the capacity. All right, now here you see 135 is far less than 450. Basically, which give you the 0.3 means that basically you only use 30%, all right, 30% of your capacity level. Okay, 30% of your capacity level. All right, very simple. Now, since you only use 30% of your capacity level, right? In total, how many machines we have? Okay, how many machines we have? It's a three, right? Three machines. Three machines are the machine number that you have, right? But if I'm asking you how many machines you are using in this year, what is the specific answer? Think about this. You have three machines, but it doesn't mean that you use all of them in this year, right? You use all of them only when the market demand is at least equal or is greater than your capacity level. But right now, your capacity level, all right, right now your capacity utilization is only 30%. Means that although you have three machines, but you only use 30% of those three machines. What is that amount? The 30% of those three machines would be 0.3 times 3, which is 0.8. Okay, so basically 0.9 here, okay, is a result of what? Which is corresponding to what? Okay, or think about this. What is the indication of the 0.9? It means that basically you have three machines, but in this year you use 0.9 machine effectively. All right, you only use 0.9 machine effectively. Okay, but since this amount 0.9, this amount is less than 3, right? Because you have 3, that's the largest amount that you can use, right? But since in reality you only use 0.9 machine, okay? Since this amount is less than 3, it indicates that okay, although your utilization rate is not that high, but at least you can feed for all the market demand. Okay, at least you can feed for all the market demand. All right, now labor requirement. Okay, think about this. So in this year, we already calculate how many machines we are using effectively, right? Which is 0.9. Okay, and then if I ask you, well, how many labors you are using effectively in this year? How to calculate that amount? Very simple. You use 0.9 times 2. Why we need time 2? Why we need time 2? Because for every machine, you have 2 operators. You have 2 operators, okay? So that's why here, the labor requirement, or effectively how many labor you're using, is 0.9 times 2, which is 1.8. Okay, which is 1.8. All right, so I'm asking you the next question. All right, the labor requirement, or effectively, okay, the labor amount that basically that is effectively going through this whole procedure, is monitoring this whole procedure, is 1.8. Okay, then actually how many labors you are currently having to kind of monitor the whole procedure. Think about this question. All right, how many labor you have right now in order for this body machine? You have how many? 3 times 2, which is 6. Okay, so basically you have 6 operators that are monitoring that can monitor the body machine. Okay, but effectively you are only using how many labors? You are only using 1.8. Okay, means that basically you actually have 6 labors, okay, that can help you to kind of produce or monitor her procedure, but you only use 1.8. Okay, so you see that 1.8 is far less than 6. It means that okay, your production level right now, all right, or your monitoring level right now is far less than the capacity level. Okay, so you are not actually have the situation that you have very huge market demand, but your capacity level right now is not enough. No, that won't be the case in this specific year. All right, but we will look at the next few years and see whether that will be the problem in those years. Okay, so here the key principle actually for the real applications is that we don't want actually we don't want the market demand is above your capacity level. The reason is very simple because Once your market demand is above your capacity level, it means that you are losing some profit in opportunity. You don't want to have that situation. And if you have this situation, what do you want to do? Very simple. You probably want to improve or increase or expand your capacity level, right? Such that your new or your updated capacity level will cover the market demand. Market demand. All right. But on the other hand, you also don't want, your capacity level is too high, is far above your utilization level. Right? Because let's say if some of the machine you buy it from, you buy it from other factory, and then actually many of them are not using. You are basically wasting resources, and by wasting those resources, actually you are also incurring some cost. Okay, so to some extent, it will also hurt your profits. So that's why we don't want, the capacity level is below market demand realization. Also, we don't want the capacity level is far above the market demand realization. Okay, the most appropriate level basically would be the capacity level is still higher than your market demand, no matter realization or prediction. Okay, but not too high compared to, the market demand realization. Okay, so we need to make a proper level for that. All right. Now, this is a bottleneck operation for year one. All right, and then actually um, uh, the same calculation procedure, the same essence can be used in order to figure out the capacity realization, the machine requirement, labor requirement for producing plastic bag in year one, year two, year three, year four, and year five. All right. Now, give you a quick example. Here for bagging operation, okay, plastic bag operation. What is the capacity for every year? How to calculate this? Think about this. See, we have this sentence, right? We have 5 machines to produce plastic bag. Every machine basically can package 250,000 plastic bags, right? Per year. All right. And for every machine, we have 3 operators. So the capacity level for producing plastic bags, or simply more descriptively, all right, the amount that's at most we can produce, okay, for plastic bag in each year would be 5 times 250,000. All right, that's the maximum amount that we can produce for plastic bags. All right, so that's why here, if you use 5 times 250,000, that will be the amount 100 once. Sorry, that will be 1,250,000. All right, 1,250,000. All right. Now next, how many operators we need? We are having right now, uh, for the bagging operations. Quite simple. Here, if you look at this fact, we have 5 machines, and each machine right now has 3 operators. All right. So it means that basically how many operators we are having right now for bagging operation? We have 15. Use 5 times 3. That's it. All right. So here, more specifically for year one, right? How many plastic bags we need to fit for the market demand? How many? 300. All right, or more accurately, it should be 300,000 because this is in thousand, right? 300,000. All right, and how many amounts at most we can produce, which is basically the capacity level, right? How many? 1,250,000, right? That would be the amount. So what is the capacity utilization? You use how many amounts you can produce. You need to produce divided by how many amounts actually you can produce at most, right? You can produce at most. That's why this is 300,000 divided by 1,250,000, or you just cancel this in thousand. That's fine too. All right. So here, that's why this is 0.24. What's this 0.24 means? Means that you only use 24% of your capacity level. Okay, you only use 24% of your capacity level. That's it. All right. Now, similarly, for machine requirement and also labor requirement is also listed here. Now, first let's look at the machine requirement. All right. So we know that how many machines we have right now. How many? We have 5 machines, right? We have 5 machines. All right. That's the amount that we have currently, right? But it doesn't mean that you are effectively using those 5 machines in the whole year, right? You only use 25% of the system, right? You only use 25% of the system. That's why the amount of the machine that you are using basically is 25% times 5, which is 1.2. Means that actually out of those 5 machines, you only use 1.2 machine. Okay, that's actually based on effectively what is the percentage of the utilization. Okay, that's why we get this 1.2. All right. Now, similarly for labor requirements, how to do this calculation? Very simple, right? Right now we already know that effectively we only use 1.2 machine, right? And for every machine, how many labor we need? How many? Is 3, right? Is 3. That's why since we are effectively using 1.2 machine, and for every machine it needs 3 people to operate. That's why we use 1.2 to times 3, which is 3.6. Okay, so basically, effectively, we are using 3.6 labor. Okay, we are using 3.6 labor, and in total, how many labor we are having right now is right here. It's 15. So basically, it means that okay, among those 15 operators, you are only effectively using 3.6 labors out of those 15, different operators. Okay, so you can repeatedly doing this whole thing for the next, 4 years, starting from year 2, year 3, year 4, and year 5. All right, and finally, okay, if you didn't have some mistake in your calculation, you will see actually the final result is showing within this table. So basically, this will be the capacity planning or capacity requirement table. Okay, it shows the utilization percentage. You see, this is a percentage. Okay, that's why this is 30. 30 means 30%. All right, this will be 31%, 54%, 66%, and also 77%. Okay, and this is for bottle operation, right? And for machine requirement, basically shows how many machine we are effectively using, which are 0.9, 1.23. You see this whole pattern. In this specific example, you see actually the effectively using machine higher and higher starting from year 1 to year 5, right? And for the labor requirement, you see that this amount is also becoming higher and higher, all right? Which basically indicates that they are actually effectively using more and more labor into the whole procedure. Okay, so this is basically the capacity requirement or capacity fact related to bottle operation. And similarly for the plastic bag operation, you can also see the percentage capacity utilization in the whole procedure and what are the effectively number of the machine that are effectively using with this whole procedure and how many labors are effectively monitoring the whole procedure. Okay, so these are the basic facts showing here. Okay, so by just looking at all these numbers, okay, at least we may get some insight, okay, about our capacity management procedure. Okay, these are not just numbers, all right? So these numbers have the specific meaning. Okay, as I just said, first of all, your utilization rate, all right? When the utilization rate itself is above 100%, what it means? It will mean that basically your capacity level right now cannot fit for all of the market demand realization. All right, but fortunately, in this specific example, you see, starting from year 1 to year 5, for bottle operation, although this number is becoming larger and larger, until in year 5, would be 77%. But since the utilization rate is still below 100%, which means that okay, right now your capacity level right now is actually still good enough to fit for all of the market demand. Okay, but let's suppose in year 6, if the number shown here is above 100, means that actually the utilization rate is above 100%. That means actually in reality, when firm do production procedure, your capacity level already cannot cover all of the market demand realization. Okay, that means that basically for your firm, you probably have to decide whether you need to improve your capacity level. Okay, that would be the point. All right. So now let's look at the machine requirement. All right, you see that this number is becoming larger and larger and larger until year 5, which is 2.31. Means that actually 2.31 machine are effectively used during this procedure. Okay, but if you look at the number that we have right now, it would be 3. All right, means that okay, this amount is still less than 3. Means that okay, we're okay, right? from the machine point of view, we're okay, and basically 2.31 machine are effectively using. Our capacity level right now is still good enough. All right. Similarly, if you look at the labor requirement, you see that this number is becoming larger and larger. All right. So this is 4.62, which is largest. All right. But this amount is still lower than our capacity level, which is 6, right? Which is 6. All right. So since we have 6 operator right now, and effectively we're using 4.62 out of those 6 operators, it means that okay, right now from labor's point of view, we're also okay. All right, we're also good enough because 4.62 out of the 6 different labors are effectively monitoring her procedure. That's fine. All right. So similarly here, if you look at the plastic bag operation, if you look at the utilization, um, the percentage, it also increasing, right? Starting from year 1 to year 5. Probably this product is good from the customer's point of view. So that's why many customers actually are using this product. All right, but you see that until year 5, okay, the utilization rate is already 95%. Okay, so if you look at this number, this number is already very close to 100%, right? So means that okay, your capacity level right now in year 5 are still covering, your basically the amounts that you need to fit for the market demand. Okay, but 95 is too close to 100%. Okay, 95% is very very close to 100%. So from the decision, let's say if you are CEO, if you are CFO, probably after you look at this number, you probably need to consider whether it's the time to further improve the capacity level. All right, this will be the time to consider whether you need to basically further improve the capacity level. All right, because this number is too close to the 100% utilization rate, and you don't actually want to lose any profiting opportunity. That's why you may actually need to consider whether you need to recruit more laborers, or basically you buy some new equipment, all right, in order to fit for this increasing trend. All right, and similarly for the machine requirement, this is 4.7, but this is still less than 50. I think it's 15, right? Yes. Not 15. Yeah, 4.7 this is still less than 5, and also for the labor requirement, all right, our capacity level is 15, right? And since this is 14.1 is still less than 15, you're still good. But as I said, since this column of number is very close to the corresponding capacity level amount, it's the time probably for CEO or CFO to consider whether you need to improve the capacity in order to in order to prevent that your profit in opportunity will lose. Okay, so this will be a quick and simple example about how to quantitatively measure the capacity requirement. And after we measure all those things, okay, we still need to look at this number and see whether right now our capacity level, our capacity requirement itself is good enough. Okay, whether our capacity level is actually can prepare the market demand realization. Okay, we don't want to lose any profiting opportunity. Okay, that's the final goal. All right, so this will be the first quantitative methods that we already introduced within the capacity management procedure. All right, so there will be another type of the quantitative methods used in another different type of the capacity management procedure. Okay, so technically this is called decision tree method. All right, actually decision tree method is widely used in different type of applications. Right now, since we are talking about the operations management, of course we can also apply decision tree into some specific problems. So here we are using decision tree for the capacity management or capacity analysis procedure. All right, so let me give you some quick sense about decision tree. All right, so decision tree basically, as I show here, definition is quite simple. It's very straightforward. All right, basically decision tree is a schematic model okay, of the sequence of the steps in a problem. So basically, in that type of problem, probably we have some different steps with certain sequence, okay, with certain sequence, including some condition and also some consequence of each step, okay. So let's say if you are actually facing a problem, and for this problem you may have some steps in sequence, all right, and you know some condition on each step, probably decision tree would be a very good technique that can help you to figure out, uh, what are those sequence and what is the best decision that we can do, okay, among all different alternatives. Okay, that's why decision tree is quite a useful technique that, and we will detailedly talk about decision tree by using one big problem. All right. So here, as I say, decision tree can help analysts understand the problem, assist in identifying the best solution, right? So basically, by using decision tree, you can plot, you can draw or plot out the whole decision tree um, diagram, and you can figure out, the sequence of different steps, and by incorporating the condition and the consequence of those steps, okay. Then by just looking at the decision tree and do some simple calculation, you will figure out what is the best solution among all alternatives. All right. So within decision tree, actually, we have three different components or different type of symbol that are, or we say different nodes that are representing different type of thing. All right. Here I already list all those three different type of the components. All right. The first type of component is called decision nodes. Okay. Decision nodes. Okay, now the decision node itself is represented by the square within the decision tree. Okay, here you just notice that basically we're using the square to represent a decision node, and then we will use the very specific example to illustrate. Don't worry about it. All right, and then for the chance node, it will be represented with circle. Okay, it will be represented by a circle, and then the path basically link between different nodes and will basically intuitively show the sequence of different steps, So basically, decision tree are, just simply structured by the decision nodes, chance nodes, and also the path. Okay, which is quite simple. Let's use a quick example. Okay, this is not that simple example, but I think the structure itself is quite straightforward. All right, so let's use this example and use the decision tree to help us figure out what is the best solution among all the different alternatives. Okay, so of course this example is about the capacity management. All right, it's about capacity planning. We have different plans, for the next few years. Okay, but as a firm, we can only choose one of them. Okay, one out of the alternatives, and in order to choose the best, the best capacity planning among different alternatives, we have to use this decision tree and do some calculation correctly, and then we'll figure out the final result. All right, that's the main idea of this example. Now, let's look at the context of this example. So the owner of Hacker's computer store is evaluating three options. All right, basically, right now, your factory basically is considering whether we should expand at current site or expand to a new site where we do nothing. Okay, so as let's say you are a CEO, right? Right now, by just looking at, let's say, the capacity planning results, you see that okay, probably it's the time for us to consider whether we should expand our capacity level or not. All right, if we choose to improve our capacity level, should we expand at the current site or should we expand to a new site? Of course, if you expand at the current site, all right, the incurring cost probably will be different from the cost that we incurred by expanding to a new site. Okay, so you see that actually for every type of the improvement of the capacity level, you probably will generate different number of the benefit by incurring different number of the cost, right? So you have to consider all those. You cannot just look at revenue, or you cannot just look at the cost. What you need to look at basically is the profit after incorporating both revenue and the cost. Okay? You can even do nothing, right? You can even do nothing because even if we we know that if we expand right now, we will generate some new revenue. But we know that if we do that, it will incur a lot of cost. All right, we may still prefer to do nothing. Okay, we may even we have some new extra money. We may even prefer to right now not expand anything. Okay, neither expand at the current site nor expand to a new site. Okay, so let's look at the more specific information that is included within this example. All right. So first of all, the decision process already shows the following assumptions and conditions. All right. So since right now you only have the prediction, right? You cannot actually predict the realization in the future, but you have to prepare your capacity level before the market demand realization happens, right? That's very logical, right? You have to prepare first before actually the market demand itself will realize. Okay, so but at least from the historical information, you have some experience about whether the strong growth of the economy or strong growth of your own firm will happen, or the will growth, the weak growth of the economy or weak growth of the your own company will happen. All right, so at least you have some sense about it. All right, although you're not quite sure which one will happen, right? So here, let's assume that the strong growth has a 55% probability. Okay, if the strong growth has a 55% probability, okay, and suppose let's only have two situations, or all right, only have the strong growth or weak growth. Okay, if the strong growth has a 55% probability, and let's say we only have another option, we only have another consequence, which is the weak growth. Then what is the probability for weak growth? Very simple, right? Because in total, since we only have two different outcomes, one consequence basically is the strong growth, which is having 55% probability. Then the other one, of course, use 100% minus 55%, which is 45% probability. All right. So strong growth has 55% probability, means that weak growth has 45% probability. Since right now we only consider these two different situations. All right. Although no matter it's strong growth or weak growth, you cannot decide it, right? This is actually decided by the whole market. This is decided by the whole market, decided by the customer, decided by the economy of that country, decided by many different factors. But at least you can predict, all right? At least you can predict whether each type of the growth, or either strong growth or weak growth, will happen with certain probability. That's what you can predict, right? So you cannot impact, you cannot decide on this, but you can predict on this probability. Okay, let's make it very clear. All right, now the next three basically piece of information are basically showing the three different alternative consequences. Okay, remember that here we have three options: expand at the current site, expand to new site, or do nothing. Now let's first look at the new site. Okay, if you try to expand at the new site, probably you can already imagine the cost of expanding on new site probably will be higher compared to expand at the current sites, and of course it will be higher if you do nothing, right? Because probably if you do nothing, basically your cost of expansion basically is zero, right? It's zero. All right. Now suppose the new site cost is $210,000. All right, and you know that okay, since you incur more costs during this procedure, okay, but you have to have some benefit, at least in probability, right? So we know that okay, suppose we try this way. Suppose we finally decide to expand a new site, all right, and then with strong growth, okay, the corresponding payoff would be 195,000, okay, and the weak growth, the payoff would be $115,000. All right, that's basically the payoff that you will have, or the benefit that you will have by expanding on the new site. Okay, with this cost. Okay, now this is basically a basic fact about the expanding on a new site. Okay, now if we try to expand on the current site, okay, you see that you also incur some cost. But if you compare to the new site cost, you see this amount is much lower, right? This is also very intuitive, right? So if you're trying to expand on the current site, the cost will be $87,000, okay, which is actually lower than the $210,000 if you expand on a new site. That's it, okay? And you can decide whether to expand your current site in year 1 or year 2. Okay, we will detailedly talk about this information. All right, but here you see for the payoff, if you fortunately if you meet the strong growth, you see your payoff will be $190,000. All right, but unfortunately, if you meet with the weak growth, then basically your payoff will be $100,000. Okay, and the last one, do nothing. If you do nothing, you do not incur cost. Okay, so from that point of view, it's good. All right, but if you look at your payoff, all right, then fortunately, if you meet the strong growth, your payoff will be 170,000. All right, if you look at this amount compared to this amount and also this amount, you see, if you try to expand on a new site or expand on the current site, actually your payoff under strong growth will be higher. All right, and still we are under the weak growth. You see this amount. Okay, this amount is this one actually is higher than you are expanding on the current site, but it's lower than expanding on the new site. Okay, so you see all this information here gives you the cost and also the payoff under either strong growth or weak growth for each alternative of your capacity planning. All right, each alternative of the capacity planning. So now let's start to use the decision tree to help calculate this whole problem. All right. So even before we do the decision tree stuff, let's use a very simple table, okay, to kind of reframe all of the information showing here. All right, it's quite simple. Look at this. So let's see. Yeah, you see. So basically, what you can choose basically is to move to new location, expand on the current store, or you do nothing. Okay. So if you move to new location, you may meet the strong growth. Okay, if you move to the new location, unfortunately, the weak growth may also happen. Okay, and you see, right now, if we are looking at the 5-year scheduling, all right, if we're looking at a 5-year scheduling, okay, we know that you see for every year, okay, if you decide to expand on a new site, every year you will earn 195,000. Okay, that's basically for the next 5 years. How many revenue you can generate in total? Very simple. Since every year you can generate this amount, then for the next 5 years you just multiply 5. All right, that's why here the revenue is 195,000 times 5. Okay, since we're just talking about a 5-year period. Okay, all right. And then what is the cost? Since intuitively, since you only expand on new site, this cost, okay, will only incur once. You are not actually expanding on new site for every next 5 years. No, you only expand, okay, at this new site in year 1, or we say at the beginning of year 1. Okay, basically you choose that factory site and then you incur some cost, all right, and in the next 5 years you will generate more profits or generate more revenue. Okay, more revenue. So the cost will be 210,000. Okay, you will incur this cost at the beginning of year 1. That's why you see this is only 210,000, not multiply 5, right? The revenue is generated based on every year. That's why you multiply 5. But for this cost, if you decide to basically incur some cost in order to expand on a new site, this is a one-time cost. This is a one-time cost. Let's make it very clear. All right. So if we use this revenue amount for this next 5 years minus this one-time cost, you will get 765,000. Okay, that will be your profit basically. Okay, that will be your profit. All right. Under the situation that you move to a new location, also you miss the strong growth. Remember it, right? So here basically, if you decide to expand a new site and also fortunately you meet the strong growth, this will be the corresponding profit that you can have. Okay, but if you decide to expand on a new site, but unfortunately, if the growth is weak, then suddenly your profit will change. Okay, your profit will change. Remember here for the weak growth, actually your payoff, all right, by expanding your new site would be 115,000 per year, right? Per year. So if we are talking about a 5-year schedule, then this would be 115,000 times 5. Okay, but the cost is still 210,000 because when you incur this cost, you are not exactly know whether you will whether you will meet the strong growth or weak growth. That's not what you know, right? So once you decide to basically expand on the new site, you will incur this amount one time. That's why here the $210,000 is still $210,000. It doesn't change, right? But you see that for the revenue part, it decreased actually, right? It decreased actually. So if you use this amount minus this 210,000, you will get 365,000. So that's why you see, even if you still decide to move to the new site, right? But if you meet the weak growth, your profit will drop a lot, right? Your profit will drop a lot from 765,000 to 365,000. All right. So these are the two possible outcomes if you decide to move to a new site. Now let's look at the second option. The second alternative basically is to expand on the current store. Expand on current store. So if you expand on the current store and if you meet the strong growth, what is the corresponding revenue? Very simple, right? Just look at this. The strong growth after you expand on current sites, okay, the payoff is 190,000, right? That's what 190,000 times 5. Okay, that's it. What is the corresponding cost? Since actually you only expand on the current site, not on the new site. That's why this is 87,000. All right, 87,000. All right. So that's why here you see 87,000 would be the cost. If you use revenue minus cost, this would be the corresponding profit. Okay, and yeah. On the other hand, if you decide to expand on current site, but if you meet the weak growth, unfortunately, then the revenue for every year is 100,000 times 5 years. Okay, this will be the corresponding revenue minus the corresponding cost, which is 413,000. Okay, so we already figured out these two options. All right. Now, the third option is do nothing, basically. All right, do nothing. But here, as I show here, right, you can decide to expand on current site in either year 1 or year 2. What it means, okay? So here we may have 3 different situations. Okay. In the first year, you may decide to do nothing because you probably want to see the pattern and decide whether we will change our whether it's okay for us, to change our strategy, right? So if you do nothing now, okay, and then at the end of year 1, if you see a strong growth, you say, oh, this is actually very good, all right? This product is worth for us to further invest, and then you may decide to expand at the beginning of the second year. Okay, this can be one strategy that the company can decide. Okay, and then the company say, okay, if I do nothing right now, even if I see the strong growth in the first year, I may still decide not to expand in next year. This can also happen, all right? That would be the second plan that this company is already made, all right? The third would be do nothing now, and if you see weak growth, they will continue to do nothing, okay? They will continue to do nothing. So these are the 3 different sub-scenario that actually this company is considering for do nothing, okay? Either do nothing and see strong growth and decide to expand on the current site in next year, or do nothing, even if you see the strong growth, they will not expand on next year, and then or you do nothing right now, even if if you see the weak growth, you definitely will not expand on next year. Okay, so these are the 3 alternatives this company is basically planning. All right, but no matter which type of the alternative, all these different things are given from the context. Okay, all these different alternatives are given from the context. All right, so if I ask you some question, at least I will give you all of the information related to different alternatives. Okay, this is not that you will decide. Okay, um, the problem itself will tell you all different information, very detailed information about different alternatives. All right, now let's look at do nothing and with strong growth and expand next year. Okay, and what is the corresponding revenue? Since you do nothing right now, okay, if you look at this, if you meet the strong growth and then you decide to expand in next year, okay, what is your revenue in the first year? Because in first year you do not actually decide to expand, right? So and with a strong growth, what is your payoff? It's 170,000. That's why here, for the first year, it's 170,000. All right, and then since you decide to expand on next year, all right, which is basically at the beginning of the second year, all right, then what is the corresponding revenue in the second year? You decide to expand on the current side, right? Then still with a strong growth, what is the corresponding payoff? 190, okay? But here, the 190,000 itself can only multiply by 4. Why? Because we are talking about 5-year schedule, right? We're talking about 5-year schedule. You do nothing for the first year. That's why this is 170,000. And then you expand from the second year. That's why the 190,000 amount can only count for the next 4 years, not for the whole 5 years. Okay? This would be a little bit tricky, but the sense here, the logic here is very simple. All right. And then what is the cost? Remember, the expansion on current site cost is 87,000, which is a one-time cost. That's why you see the cost will be 87,000. Okay, 87,000. That's why here you see the value is showing here. Okay, and then let's say if you do nothing now and you see, fortunately you see the strong growth, but if finally you decide not to expand anyway, okay, then what is the corresponding revenue? Very simple. Basically, you do nothing here, and with a strong growth, you get $170,000 for every year you time for 5 years. All right, what is the cost? You do nothing. That's why the cost is 0. This will be the corresponding profit. All right, and here if you do nothing now, and by looking at by seeing a weak growth, you definitely would choose to do nothing for the next years. And here you see the weak growth, the do nothing schedule, you'll get a payoff 105,000. That's why here this 105,000 times 5. That's it. And the cost is still 0. That's why the whole profit will be 525,000. All right, that's it. So these are the a simple calculation based on the information shown here. You see, by transforming into a table, all right, the information itself, the information doesn't change anything, right? But here you will see that actually all the information shown here is more structural. It's more structural, all right? And once you have this, you are ready to build up the decision tree. Let's look at this decision tree, okay? At the first glance, you may feel this decision tree is very complicated, but to be honest, the decision tree itself is very, very straightforward and very simple as long as you understand the key sets. So don't worry about it. All right, now, these are some, actually, I include all of the key information showing on this decision tree. All right, showing on this decision tree. Or let's say, let's first look at this decision tree. Some key elements. Remember, for the decision tree, we have 3 key elements: decision nodes, chance nodes, and the paths. All right, let's look at this by using this example. First of all, for this hacker computer store, this will be the component that is basically deciding, which alternative that this company should use, right? So as a company, okay, he has 3 options, right? 3 options. So no matter he chooses to move to a new site or expand on the current site or do nothing, this is this company's decision. Okay, this is this company's decision. That's why here you see, in order to represent the decision node, we use this square. Okay, this is just a symbol showing here. Okay, basically means that okay, at this point you need to make a decision. You need to make a decision. Okay, Either you move to a new site, or you expand on a current site, or you do nothing. But no matter which one you choose, this is your own decision. All right. Okay. Now, and no matter you choose move to a new site or expand or do nothing. All right. And finally, the economy growth or the product growth will realize, right? You only have two consequences. One is basically the strong growth, another one is called weak growth. Okay? As I said, no matter it's a strong growth or weak growth, this is out of your control. This is out of your control. All right? Based on the previous or historical information, you can have some experience about it. That's why you can predict that basically the strong growth here would be 55%. And the weak growth here would be 45%. All right, that's why you say 55%, 45%. Okay, and no matter which one, which decision you choose, you see the strong growth is always 55%, 45%. You see 55%, 45%, 50%, 45%. That's it. All right. So basically the circle here is showing the is showing the chance nodes. Okay, the chance nodes. This is out of your control. This is out of your control. All right. Now, once you move and the strong growth happens, you have the corresponding profit, right? We are just calculate all the profit showing here, right? You have the corresponding number, and if you move, but the weak growth happens, unfortunately, then the corresponding profit will also have a corresponding profit shown here, right? And if you decide to expand with a strong growth, you have this corresponding profit. If you expand with a weak growth, there is a corresponding profit. Okay, here, if you do nothing, okay, as I said, if you look at the growth, if it's strong, okay, here, as I said, for do nothing strategy, you have three scenarios, right? The company basically is considering three different alternatives under this scenario. Okay, and if you do nothing, and finally, fortunately, the strong growth happens, you may decide to expand in the next year. You will have the corresponding profit, right? But you can still do nothing, even if you see the strong growth. There was a profit showing here, right? And if you do nothing and the weak growth happens, you will do nothing eventually. Okay, you will see a profit showing here. So you see that from this decision tree, right? You moved all of the information in this table further into this diagram. Okay, and this diagram basically gives you not only the payoffs amount, but also the sequence of different decision and also the consequence. Okay, the consequence. So that's why you see the decision tree itself is more sophisticated, and actually it will help you to calculate and finally decide the best option among all the alternatives. Okay, so you see here I basically just list all the numbers that we just calculated within this table. 765,000, 365,000. You see 765,000, 365,000, right? So basically just list all of the payoff, okay, for different node or different paths. You see, as a company, you first need to you basically decide, three alternatives, okay, and let's say for every alternative, okay, once you decide, you won't affect the either the strong growth or weak growth that is out of your control, right? And the corresponding profit is showing at the end of every pass. All right. So right now, what we will do basically is to pick up the best option among all these alternatives. Okay. So how to basically calculate or how to decide which one is the best among all these alternatives? Okay. Very simple. Let's do the calculation. First of all, let's just look at this first. Let's say just look at this first branch. Okay. If you decide to move, and there's a 55% chance we have the strong growth, there's a 45% chance you will meet the weak growth. Okay, these are the corresponding profit if the strong growth happens, if the weak growth happens. Okay, but on expectation, what is your profit? If I want to know that specific amount, how to calculate it? Okay, think about this. if I want to calculate the on expectation, how much money we can get if we decide to move to a new site, how can you calculate? Very simple, right? Basically, this is basically corresponding to calculate the weighted average of of this specific branch. Okay, if you decide to move, since you have 55% chance you will have the strong growth with this profit, you have 45% chance you have this weak growth with this specific profit, then basically your expected profit, okay, if you decide to move to a new site, would be this amount times what? Times 55% plus this amount, 365,000 times what? 45%, right? Think about this. It's quite simple, right? So basically, you see, we're using the weighted average method to calculate the expected profit if you decide to move. Okay, very simple. So that's why here you see easily just use the 765,000 times 0.55 plus 365,000 times 0.45, you will get the corresponding number. That's why here the expected value that you can get if you choose move to a new site would be 585,000. All right, 585,000. That's it. All right. Now, after I illustrate the move to new site branch, all right, if I decide to expand on the current site, what is the expected profit? The key sense is exactly the same, right? Basically, you see, although the number shown here is different, different, but if you decide to calculate expected profit here, you just use the 55% times the 863,000 plus the 45% times the 413,000. That's it. All right, so that's why here you can see that, I directly showed this number. I didn't show you the procedure, but as I said, in order to calculate this, you use this amount times the 55% plus this amount times the 45%. You will get this corresponding number, which is 660,500. All right. So these are the two expected profit. All right. Now let's look at the third one. The third one is looks a little bit complicated. All right, but we already know that for the weak growth, right, the revenue is 525,000. All right, but for the strong growth, okay, if I decide to expand, the profit is 843,000. But if I decide to do nothing, actually the final profit will be 850,000. Okay. You see, the basically either expand or do nothing. This is exactly under your own control, right? Remember that here this is a square. The square represents your decision node. You can decide whether to expand or do nothing. Okay, so between expand or do nothing, which way you should choose? The core criteria is that the core criteria is that if I choose this way, it will give me more profit. I would definitely choose this one. Okay, I will always choose the way that can provide more profit from the business point of view. All right, so here you see that if I expand, I will get 843,000. But if I do nothing, I will get 850,000 for profit. Which one should I choose? Of course, do nothing, right? Because if you do nothing, your profit actually will be higher. Why not, just do nothing and get this high profit? All right, so that's why here. So between expand or do nothing, for this sub branch, you should choose do nothing. Okay, so once you should choose do nothing, that's why here you see. That's why here you will not consider expand anymore. Okay, so basically this sub branch, you will ignore this sub branch. Okay, so after you ignore this sub branch, all right, then do nothing. If you choose do nothing, all right, and then if you miss a strong growth, again you choose do nothing since the profit is higher than expand. Okay, so basically it tells you do nothing with a strong growth. What is your profit? It's 850,000 since you always choose do nothing here. Okay, but do nothing, and if you meets weak growth. What is your profit? It's 525,000. All right. And then how to calculate expected profit of do nothing? Very simple, right? Because for strong growth, your revenue, your profit will be 850,000, and with the weak growth, your profit is 525,000. The expected profit, just 850,000 times 0.55 plus 525,000 times 0.45. Then you're getting expected profit of doing nothing, right? Again, this branch is already ignored because this amount is lower than this amount. That's the reasoning. Okay, don't forget about this. All right, now after doing this simple weighted average calculation, all right, you can already get the basically the expected profit for all different three alternatives. All right, see if you move to new site, what is the amount? 585,000. Okay, if you choose to expand on current site, what is the amount? 660,000. Okay, if you do nothing, what is the amount? 703,750. Which one you should choose? If you just look at these three numbers, suppose these three numbers are correct, you should double check it, right? And then if you suppose these three numbers are right, which one should you choose? You should choose do nothing. In this specific example, all right? In this specific example, with all the specific numbers, you should choose do nothing. Because, right? Because this alternative will provide you higher profit compared to expand on current site or compared to move to a new site. Okay, that's why you do nothing. Okay, but let's say if I calculate this amount, and this amount is not 703,750, it's 603,750. Then which option you should choose? You should choose expansion on the current side because this value is higher. Okay. So I can, of course, I can change all the values showing here, all right? And after I change all the values showing here, probably the result will be different. But the key sense would be exactly the same, right? Basically, you always choose the option that will provide you more profit as a firm, okay? That's actually very intuitive. So that's why, this is basically a great example that can help illustrate how we can basically use the decision tree in this capacity management type of problem. All right, very, very important. All right, so I may actually give you some different context, give you some different problem, but you see the key sense showing here by using decision tree is exactly the same. All right, first of all, you need to understand what it means, this square mean, what this circle mean, as I just detailedly talk about. All right, and then when you calculate for every branch, you need to calculate the weighted average. And then you need to basically compare the weighted average and choose the basically the highest one. That will represent the best option that will provide you most profit. All right. So this is basically extension about the decision tree analysis. Okay, the key logic inside here is exactly the same. Okay. So first of all, basically, when I just talk about the decision tree problem, I make a big assumption. Okay. Hopefully, you guys already figured out. All right. So you see that here when I talk about this context. Okay. When I talk about this context, I say that under strong growth, basically the payoff is $195,000. Right. You can even imagine that, right? So basically, for year one, you will earn this amount. Year two, you also earn this amount, right? In year three, when you basically move to a new site with strong growth, you also earn this amount. Okay, but even if you earn the same amount, the same amount in different year, okay, actually is not representing the exactly same amount, right? If we consider the time value, okay, $1,000 in year one is not equivalent to the $1,000 in year two. It's also not equivalent to $1,000 in year three. Okay, that's actually quite simple. And if you are majoring in finance, you probably notice something about what I will talk about here, which is called net present value. All right. So we know that $1,000 in year one is 1,000. All right. Suppose right now we are in year one. All right. But the $1,000 in year two, okay, the $1,000 in year 2 is not actually exactly $1,000 in year 1. Okay, so if we consider time value, it probably will represent lower value of amount compared to $1,000. Okay, so I will not detailedly talk about the decision tree analysis with net present value, because the key logic here is exactly the same, except that basically when you calculate uh, when you calculate profit, all right, you have to, let's say right now if you are in year 2, if you earn $1,000, it's not actually equivalent to $1,000 in year 1. Okay, you have to do a simple transformation. Okay, you have to do a simple transformation. Basically, since this, let's say this is in year 2, you're actually you're let's say you're earning $1,000, all right, and then if we tend to transform back to year 1, okay, what is the corresponding equivalent amount that can represent $1,000 in year 2? Okay, this actually will need a simple transformation. You basically need to use $1,000 times a value to get the updated equivalent amount within year 1. Okay, I think the textbook already shows very clear description about it. Okay, and you probably will need to use the appendix C within a textbook in order to find that value. All right, so this will be the extension of related to the decision tree analysis, and we will not cover within exam, but I think probably one homework question will relate to this. So my suggestion is to look at the textbook and look at the appendix C, and it will show the corresponding, the transform ratio that will help you to basically get the corresponding net present value. Okay, that's it. And for the whole logic inside, okay, the whole logic inside is exactly the same as I just said, for the example 4.2. Okay, so let's make it very clear. All right. So these are all things related to decision tree analysis. All right, and now within a textbook, we also talk about the service capacity. All right, the service capacity. Okay, we all know that actually service type of the industry is also quite important. All right, in current business. So that's why here I would like to do a simple comparison between manufacturing capacity and service capacity. All right, and more details are actually shown within the textbook, such that I would require every one of you to look at the textbook and look at those materials and get a good sense about the difference between manufacturing capacity and service capacity, and also what is the key characteristic of service capacity. Okay, I will briefly go through here. All right, here. So if you look at the manufacturing capacity, right? So we all know that for manufacturing type of thing, if you produce products, goods probably can be stored for later use, right? Goods can be shipped from one location to another location, all right? And also, within the manufacturing type of the industry, the demand volatility is relatively, lower, okay? Because the market demand for a certain product relatively, is more stable compared to the service type of the industry. All right. And on the other hand, if you look at the service type of the service type of the industry, you see that the capacity must be available, right, when service is needed. Okay. So basically, if the customer comes, you basically you provide this type of the service that you within your firm. Otherwise, the customer, if you cannot provide a service, the customer will go away and probably will find another place in order to get the service. All right. So also the service must be available at the customer demand point. Okay, and the volatility of the demand will be very fluctuated. Right. So compared to the manufacturing type of the industry, the service type of the industry, the volatility itself is very high. All right. So I think all these things are very logical, right? Because service type of the industry, is actually more real time. All right, and the volatility during the whole procedure is higher. All right, and you also need to consider, when you provide the service, what is the performance, what is the quality, everything actually becomes a little bit more fluctuated. All right, so you have to, that's basically telling you that you have to monitor the whole process very carefully, okay, when you provide services. All right, now, another thing. Since we already talked about the utilization, right? So we say that under the manufacturing product type of the industry, all right, we say that basically the utilization, okay, of the capacity level, probably, you know, utilization itself should not be far away from the capacity, all right, and it should also not, even above the capacity level. That's not good, okay. But if we are talking about the capacity level under the service type of the industry, okay, then actually the relationship between the service capacity utilization and the service quality is is more complex. It's more complex, all right, because the reason is quite simple. Let's say we are producing product, and let's say if the machine is producing the whole the producing this product in the whole procedure, all right. So as long as this machine is working well, as long as this machine is doing the this production procedure very smoothly and correctly, all right, you are not actually that concerning about the quality of the product because everything is actually in order. Everything is basically just is following a specific type of the method, following a specific type of steps. All right, but okay, in the service type of industry, okay, when you provide, let's say if your capacity is 100%, all right, if you provide service, the utilization rate is around 90%, okay, it may actually negatively impact the service quality, okay. So when the utilization is very close to, not even very close, is becoming closer and closer to your capacity level, all right, the quality of service probably will drop down into some extent, right? Because when you provide services, everything's become very busy and may have more issues during this procedure. All right, so that's why the optimal level of the utilization, okay, can be very complex under the service type of the um, industry. Okay, and I think many economics and many even psychologists are doing many research related to um, figuring out what is the relationship between the optimal level of utilization and also the service quality. Okay, this relationship. Actually, many researchers are doing this type of research. Okay, first of all, the optimal levels of utilization itself is context specific. Okay, so it's not like within the manufacturing type of the industry. Okay, in the manufacturing type of the industry, then basically we really want that the utilization level will be a little bit closer to the capacity level, but you will not cover you will not over a capacity level. All right, but here for the service type of the industry, the optimal level itself sometimes can be should be low rate. Okay, sometimes the optimal levels of utilization itself should be a low rate. Why? As I show here, all right? Because in those cases, okay, if you are facing a high degree of the uncertainty, okay, or the stakes are very high, okay, as I show here, right? If we are talking about emergency rooms, if we are talking about fire departments, all right, the optimal level of the utilization for this type of this public service um, situation, we of course want the rate of the level of utilization should be low, okay? Because the uncertainty degree is pretty high. That's why we really want this the optimal level of the utilization for this type of public service to be low. All right, that's actually very logic. Okay, but sometimes the optimal levels of the utilization here can be a little bit higher. All right, as I show here, right? So in what situation? Very simple. If you can have a predictable services, okay, or those without extensive customer contact, all right, as I show here, for those commuter trains, for those postal sorting, all right, for some other examples, as long as you can predict this service by using some historic information, all right, you all have some expectation about the service number or what is appropriate level about providing those services, then your optimal level of the utilization itself can be a little bit higher. Okay, so that's why here for the optimal level of the utilization, it should be context specific. And in some circumstance, probably it's better to keep the utilization level to be low. All right, but in some other situations, okay, especially when you can predict some of your service level, then you can put your level of the utilization higher. All right, that's actually appropriate. All right, so okay, so here in this picture, I basically just give you some quick sense about the relationship between service utilization and service quality. Okay, as I said, some researchers already have done some research on this the relationship between these two. All right, so some interesting details are showing within the textbook. So here I will not detailedly talk about it. If you're interested, you can look at the textbook. So these are all the course materials related to chapter 4, and thank you for watching. See you soon, guys.